Welcome everyone. It's time for a Patreon exclusive. In this one, we're going to be doing a portfolio review. I'm going to be sharing some additional thoughts on the passive income portfolio, as well as that valuation little spreadsheet that I shared. This one right here. I had it in the last episode. It was a fun thing to look over. I just want to explain that a little bit more. And then we also have, of course, the Ask Me Anything, which is the main thing we'll be doing. We have a lot of questions. I haven't read these in advance, so I'm going to be going through them live with you, all of you. So we have a lot to get into, a lot to go over. Let's go ahead and just jump right in. First things first, the Patreon growth, the community growth here has been incredible. It's been steady and consistent over a long period of time, but it's actually been speeding up over time. I took a screenshot from the Patreon dashboard, and this is the amount of members we have here since the very beginning. So back here it was January 2020, right? We're just getting started. I started the Patreon. We had a few early fans join. And then I started building Qualtrim, investing more money into that, hiring developers and that type of thing. And it's just built over time. It's pretty interesting to see this growth from 2020 to 2023 to current day. We've recently had a big influx of new members. And something that I've noticed is it seems like a lot of the members here are coming from different channels. They've gone through some rough experiences, some of them. I've talked to some people that have invested in a lot of companies that have dropped a lot. They've had struggles, and they've decided that they want to maybe go a different route in investing, focusing on longer term investments, higher quality companies with better economics and fundamentals, wider moats. And I think the channel and the content here has really connected with a lot of people because I've been able to show how my portfolio has done over the past couple of years. So you can see the total returns in totality since the beginning and everything I'm doing. And I think that that's been a different thing than I still think a lot of creators do. A lot of them are not showing the full picture. They show only current holdings, not the ones that have dropped 80%. A lot of them are just showing you snippets. And I think showing the whole thing here has really helped out with new people. So if you're one of the new members here, I can't promise guarantees of any kind. There's no looking into the future and promising guarantees or guaranteeing and promising any type of returns. Anybody that does that, by the way, if they promise you a 10% return or a 20% return, you can almost instantly know that that's going to be a scam. So there's no way to guarantee any type of returns in the stock market for a given period of time. But what I can guarantee is we're going to show you the process, show you what I'm doing, show you where I make mistakes, where things go well, companies that are doing well. I'll try to relay my thought process as I'm buying these companies as transparently as possible. And we'll see what happens. I'm going to be transparent. That's the guarantee here. The hope, not a guarantee, but a hope is that we can do really well and that we can outperform the major indices, that we can beat the S&P 500 and even the QQQ over the next 5 to 10 years. It's difficult to do. They're really good indexes. They hold a lot of great companies. But I look at my portfolio and we have a really good group of companies here. So I wanted to go ahead and just talk about the portfolio here for a minute. Actually, just one last thing before I go into the portfolio. We have more updates coming to Qualtrim. I've been connecting with the developer again. We took a week break because we went on a big sprint for the past couple of months. So we took a week break, but we're back on it now. The next thing that's going into Qualtrim is going to be the dividend charts. So under dividends here, we're going to have a lot of visuals here. All the charts of growth and projections and that type of stuff. We're going to add them back to Qualtrim here. It's going to take maybe, I can't give an exact deadline, but maybe a month or two and maybe shorter. I'm not sure. But either way, all the dividend charts are going to be there as well. So there's the update on Qualtrim. Let's go ahead and jump into the portfolio. And I want to share additional thoughts on this. Now, what I'm trying to do, and I've relayed this over and over again, I think the biggest question, a lot of people say the biggest determining factor in outperformance is buying companies cheap. Okay, that's what determines outperforming. That's what Buffett did. That's what Benjamin Graham says to do. Buy companies cheap, and that's how you outperform. I think that's empirically proven wrong. Benjamin Graham, the father of value investing, made over 50% of his returns from one company, Geico. That was it. Every single other decision he made, all of the companies that he bought had different price to book values and, under certain tangible asset levels and certain balance sheet levels that he did all of his buying cheap analysis. That made up for less than 50% of his total return. The big majority of his excess returns came from Geico, a growth company, a company that it didn't really matter if he bought it at a 20 or 30 PE ratio. The company, it grew so much over such a long time period and gave such marvelous returns that he even acknowledged that that really is where the majority of his returns came from. Charlie Munger also has pointed that out, that Benjamin Graham did all of this work to find all of these great value deals in so many companies, but yet over 50% of his returns came from one company that it just happened to be a really good company. The outperformance wasn't because he bought it so cheap. The outperformance was because the company was so good, it compounded for such a long period of time at a decent clip. With Warren Buffett, the big outperformance has not come from buying companies on the cheap. That's not how Buffett has outperformed. You can actually look at this and do the math. He has made the majority of his money on companies that have compounded for long periods of time. Geico being one of them. The railroads being another one. Not buying them super cheap, but just holding great companies that grew free cash flow year after year and paid huge dividends. He also made a killing on American Express, another company that he considered extremely high quality, similar to Visa and MasterCard. All these companies, another example is Apple. Now, you can say he bought Apple for cheap, but keep in mind, at the time that Buffett bought Apple, it was expensive at the time. Everybody said it was expensive. What did Buffett do? He spent $30 billion on a company that was extremely high quality. And I can go on example after example. Phil Fisher, he's more of the grandfather of, instead of value investing, he's kind of the grandfather of quality investing. Look at all the qualitative metrics. What Buffett talks about more resembles Phil Fisher now than it does Ben Graham. You can look at Charlie Munger. Charlie Munger heavily influenced Warren Buffett to stop looking for cigar butt companies and instead focus on ones that were compounding machines, that would grow earnings every year, that would spit out cash consistently, that could charge very high prices because of the brand value. He was excited about See's Candy, the best buy they've ever done, a company that they bought for $35 million, and it's printed $2 billion in cash over its lifetime. Incredible returns because it has brand value. All these investors that really made a fortune, they made it by buying growth machines that compounded for long periods of time. And I can go through all these different investors. When Peter Lynch writes about his different investments, he was an investor that was, he had no one religion of investment. He would go into anything. He would buy cyclicals. He would buy slow growers. He would buy fast growers. He would buy junk companies. He'd buy high quality companies. Peter Lynch would buy companies that he'd find value in any place whatsoever. But again, he made the majority of his money in companies like Home Depot that just grew a lot for long periods of time. Those were his favorite type of companies to own. Not the super slow growers, not the ones that were the cheapest that were junk, but the ones that would just continue to compound. So the type of investing that I've concluded that I have the highest likelihood of, first of all, having good risk-adjusted returns, and second of all, if I'm going to do analysis on individual stocks and try to determine ones I think will outperform the index, the ones that I personally feel will have the best risk-adjusted returns and the highest likelihood of beating the S&P 500 are very high-quality compounders, companies that have immense growth ahead of them. They have very capital-efficient business models, and I'm not going to pick all of them correct. I'll make mistakes, but if I buy a basket of them, and I buy them strategically when they do go on sale a little bit, and then I just continually compound this basket, I think that I have decent odds of beating the S&P 500. And I think if I don't, which the past 2 years, this portfolio has been beating SPY by about 2% each year. And even if I don't think I'll trail it by much. I don't think it will be a total disaster. We're not going to have tragedies where companies go down 80%. Not with this portfolio. Very, very unlikely for these type of companies to have that happen. I don't consider these high risk bets. So that's the type of investing that I've been focusing on. But I still like studying different ones. I still like studying all different types of investing. Highly cyclical companies. I still like looking at super deep value plays and different things as well. But let's go ahead and take a look at the portfolio and where it stands now. We're back up to $82,000 in gains. This year has been going really well. We're up around 15% this year. So slow and steady gains, not as good as I'd like. We did a little bit better. We did really well last year as well, but it's been good this year, especially not having a ton of big tech. I just have Apple and Microsoft. Other than that, I have other companies outside of big tech. Now, if we look at the valuation, let's go ahead and take a look at a couple of these. So we have right here, let's take a look at the valuation. This was a little bit of a curveball because a lot of people look at valuation and they want a stock price number for the value of an asset. They want to know, do I buy S&P 500 at $400 or $500 or Intuit at $400, right? When do you buy these companies? There's a couple different ways to look at valuation. In fact, there's dozens of ways to do valuation, but there's two primary ways to look at valuation. There's relative valuation, where the thought process here is there's always an opportunity cost to everything. So if you put your hard-earned money and you want to invest it into some cash-producing asset, well, you could throw it in real estate. That has a cap rate, an expected future cash flow, a yield on the property that you're getting, and an expected level of appreciation. You can try to figure that out, and then you can benchmark that against the S&P 500. See if your real estate investment's going to beat SPY. Or you can look at Apple and see if Apple's going to beat SPY. Or you can look at, Intel and see if Intel's going to beat SPY. And then you look at the cap rates and the cash flows, and you benchmark them relative to SPY. What that is relative valuation. We're looking at our valuations of our companies and the price of them and the expected future cash flows relative to a benchmark, which is the S&P 500. That's what this is right here. This is a relative valuation of my companies, their free cash flow yields, their expected growth rates by my analysis over the next 5 years, and then benchmarked against the standard benchmark, which is the S&P 500. This is the opportunity cost. This is where I would put my money if I wasn't doing individual investments. Now, another way to do valuation where you get just absolute value of a stock, well, it's called absolute valuation. You can get an absolute value for every company with a specific dollar price, and that is through doing something called discounted cash flow analysis, where you try to predict what the company will produce in terms of free cash flow, and then you also discount that for a discount rate appropriate, basically your opportunity cost over that time period, because there's a time value to money. And that gives you a total dollar amount, a market cap value that the company's worth. So this is not absolute valuation. This is relative valuation. What this shows is that based on these calculations of the starting yield, what these companies are yielding right now, and then their growth predictions that I have made over the next 5 years. This is the free cash flow per share growth. Companies grow their free cash flow per share, good ones, much faster than their revenue. So don't get those confused. This is the most accurate predictions I've made of their free cash flow per share growth over the next 5 years. And when I do the math, this gives you what you're getting in terms of yield at the end of 5 years if you invest in the company at today's price. So for example, if this calculation is correct, S&P Global has around a 3.4% starting yield. It's growing at 15% per year. By the end of 5 years, based on today's price, I'm getting a 6.8% free cash flow yield. Now I compare that against the S&P 500. The same calculations, the starting yield, 5-year growth rate, the end of 5 years, the S&P 500's yield will be 5.4%. That means that even though today S&P Global has a lower starting yield, because of its dramatically faster free cash flow growth rate, I'm projecting that in 5 years, this buy today, my money going into S&P Global today will buy me more cash in 5 years than the S&P 500. So putting my money in S&P Global today is going to get me more cash in 5 years than the S&P 500. Now, that doesn't tell me what S&P Global is really worth. That's a whole different question. I'd have to do discounted cash flow and absolute valuation. All this is saying is that based on the opportunity set, if I have only two options, true and false, or A and B, I can put my money in S&P Global or I can put it in the S&P 500. This one is more of an attractive investment than this one. So it's just relative. They both could be overvalued. This doesn't answer that question, but it does say that one of them is more attractively valued than the other. Since my goal is to beat the S&P 500, I'm not going to go into the business of trying to evaluate whether or not SPY is expensive or not. I don't think SPY is in a dot-com bubble, so I'm not concerned about that. My goal is to beat SPY and buy companies that will beat it. So this is how I look at it. And based on this, all of my companies are either close or a little bit above. The only ones that are below, which are worse relative valuations, is Costco and Microsoft. I ran the math a couple times. They just seem like they're a little bit worse. They're good enough companies that even though the math, it shows that they're a little bit relatively worse of investment, I'm still going to hang on to them, but I'm not adding to either of them at this moment. But other than that, most of these are showing out a much better, attractive 5-year yield on cost. I'm getting a much better 5-year yield on cost, specifically with the railroads. Even with, I think, reasonable assumptions, Canadian Pacific growing 15% per year, which I think they can do, that's a 7.2% yield. I think that's probably why Bill Ackman bought so much of this company. He put a huge percentage into it. Then we have Union Pacific growing at 10%, even a slower growth rate, moderate 10% free cash flow per share. It's going to be 7%. So much higher yield than SPY. But when I average them out between all of these, we have the average of my portfolio, and that's 5.7% against SPY's 5.4%. So this shows that I'll have more cash flow by buying my portfolio today. In 5 years, I'll have more cash flow than if I bought the S&P 500. Even though the S&P 500 will give me more cash flow this year, because my portfolio is expected to grow at a much faster rate than SPY. In the S&P 500, there's the average growth rate, which is 8%. But to make an average, you have companies that are below that are growing at 2, 3, 4%. And then you have companies that are growing way above that, 16, 17, 20%. What I've done, and I've tried to target the companies that are growing above that and can continue to grow above that, the ones that are pushing the entire index up. These are the companies that really push the index forward. They raise the overall averages of the S&P 500. The companies that lower the averages and free cash flow per share are regional banks and highly cyclical companies and industrial companies that go through bouts of good performance and they have a year or 2, 3 years of bad performance. So I'm trying to focus on the companies that have perpetual good growth above the rate of the S&P 500. Now, even though this looks similar after 5 years, 5.7 to 5.4, the companies that I'm invested in are of much higher quality. So even if they're producing the same amount of cash, or my portfolio is producing only slightly more, I'm assuming that the multiple my portfolio is going to be given on its cash flow is higher than the S&P 500, which means that the outperformance should be a lot even more striking than this. Because I don't think, for example, MasterCard is ever going to trade at the S&P 500 average. If MasterCard trades at a 17 forward PE or a 3.74% free cash flow yield, it means growth slowed down and things went wrong. The same thing with all of these companies. The reason they trade at higher multiples is because they're better companies. And I think they'll still be better companies in 5 years. So that's the thought process behind this. This isn't absolute valuation. I've done that on every company. I've done discounted cash flows. I've looked at all the valuations, both directions with these companies. And I get the same thing, that they're usually undervalued. I think they're going to do really well based on today's valuations. But so far, I'm holding these companies. They're all doing really well right now. The market's going up a little bit. S&P Global, I think, has taken off a little bit, $6,000 in the green. MasterCard now $2,200. Intuit just a hair in the green, $1,400. We go into the tech category. These are the two that have really, the outperformance has been incredible. Microsoft up $11,000, Apple up $25,000 now. And I still today think that Apple is not overvalued. 3% starting yield. I think it will have 15% growth. You may not. I think it will. We'll be able to check back in 5 years. But if we look at these, let me show you how big of an outperformance this is over these companies. So we go to my watch list here. Let's do passive income. This is my portfolio. And we'll go to year to date. This is what it looks like. The dip finder as part of Qualtrim. I can look at how my company's traded. Vici and Union Pacific, just flat. Vici's basically flat with dividends. So I'm not losing money on it, but it's just taken a rest after last year. It had huge outperformance last year. Union Pacific's just been a bummer. There's no There's zero magic in that stock. Nobody likes it. The CEO's leaving. They don't even know who's going to run the joint. I think it's a great asset, so I'm going to hang on to it. And then we have some ones that are basically inline performance, 10%, 12%. This is around where SPY is. All right. And then we have, of course, the standouts here. Microsoft and Apple. Microsoft up 40% this year, Apple up 50%. So I'm not adding to either of these, but I am still holding them in the portfolio. And I'll be looking at adding to different companies based on where I think I can just get the most bang for my buck. I'm just looking for the best value. I've already done extensive analysis on the companies. I love all the companies. So right now, it's just about getting the best value. Now, one thing I want to mention is even though I've made my stock picks, right, I have these companies like Vici, I have Texas Roadhouse. I've had the companies that I've picked. I don't want to leave the impression that these are it and these are the only good companies in the market. I only have limited time to look at so many companies. There are thousands of amazing companies out there that can give great returns. And if you do the research on them and you come up with a good thesis on them, if you look at them in Qualtrim and you find a company that has excellent economics and it's being discounted for some temporary reason, those are times that you could take advantage of. So there's lots of companies out there. There's constantly ones I'm looking at as well that I think will be great companies, but I can only have so many in my portfolio. I can only focus on so many. But don't get the impression that you have to copy this portfolio, that this is it, these are the best companies, and there's no other companies to invest in. That's not the case. There's going to be companies out there that beat this one. It's just a matter of finding it. Now, moving on, let's go ahead and jump in to the Ask Me Anything. We'll start off where we left off last time. So if you're new here, this is the AMA. It's where I answer your questions. I haven't read them in advance, so we're going through this together. What are your thoughts on investing in small caps? $300 million or less, too unpredictable, or the perfect place for 10 baggers? I think if you're looking for quick 10 baggers, I think looking at 300 million or less is a good place to start. Obviously, with the smaller market cap, they can go crazy much easier. I personally do not like investing in micro caps. And the reason, there's a multitude of reasons. One of them is I do think they're unpredictable. They typically don't have moats. So you're just raw growth. Hopefully the company can grow because they have no moats. Anybody can copy what they're doing. I haven't seen a $300 million company that has a significant long-standing moat. And since I like moats, I like competitive advantages, I like the bigger companies that can continue to compound. I do think they're unpredictable. And in the tier of what I value with my companies, predictability has bumped its way up to almost the very top. I want highly predictable companies. Where Buffett talks about companies where you could shut down the market for 10 years and you just sleep soundly at night, knowing in 10 years you're going to wake up, that company's going to be worth way more. So I'm picking companies that I think their cash flows and their future outlook are incredibly predictable. You don't get that with $300 million market cap. Also, there is a concern with very small market cap companies that if you have any type of following, for example, if I made a video and I said, I'm buying this company today, I'm putting $20,000 into it or $30,000 into it, right? Big video, exciting one. The videos where I say I'm buying a new stock, they'll get 150,000 views. When a video gets 150,000 views and it's all people that are investors viewing this video, and you're saying that you're buying a micro cap company with a $300 million market cap, that's not a big market cap. There's a lot of people that have way more money than me that watch my show. There's people on this Discord that manage $50 million portfolios. They have huge amounts of money. So they could reasonably, especially after hours, move the market cap of these companies like crazy, bump them up 5-10%. And then that would give me opportunity to say I'm buying the company, have a bunch of people dive in to get in to the company that's really small that they think will do really well. And then I could sell out and take the gains. That is market manipulation. And whether that's my intention or not, even getting perceived that way, I view as a risk to my brand and a risk in regulation and all sorts of things. So I don't even want to get close to that danger. I want to stay far away from it. Again, it's like Buffett talks about, if you have a bridge that's that's able to hold 10,000 pounds, and you have a truck that weighs 9,999 pounds, you might want to go find a different bridge. Even though you're under it, you might not want to, just don't get too close to it. I try to run the channel the same way. I don't like getting too close to stuff that I could be even perceived as doing something unethical, something concerning to any type of manipulation. What are your thoughts on Texas Roadhouse's new CFO? I think fine. I really, I like the previous one. She just instilled a lot of confidence, had been there a long time. So I feel like the new one's fine though. The CFO basically knows all the numbers, all the margins. Like they are the ones that will really tell you the story of how the company's running. It's funny because I can't remember the exact quote, but there's a quote that's like, if you want to just hear some fun things, talk to the CEO. If you want to hear how the company's actually doing, talk to the CFO. I think that's true for Texas Roadhouse too. The CEO is moreover just the vision, making the food good and making sure customers are happy. And then the CFO works with like commodity prices and basically all the nitty gritty. But I listened to the last earnings call and it didn't cause me any concerns. I didn't notice anything bad with morale. I think she was just wealthy. She made millions of dollars. She'd worked at Texas Roadhouse for 20 years, very successful. All of her stock went up like crazy. She's just retired. Some people don't want to be in the grind forever. They're not all workaholics. I think she just wanted out after a while. Joseph, I have a great idea for your punishment if your story fund doesn't beat the market. I didn't know we were thinking of punishments. I thought the punishment would be not beating the S&P 500. That's punishment in and of itself. Keep in mind, I don't like losing. I am competitive, extremely competitive. I don't like losing, and I'll do everything I can to beat the S&P 500. So I'm not looking for additional punishment here, but I'll continue on. If you're way below the market at the end of 5 years, Kathy Wood style, you would liquidate your portfolio and use the money to invest in real estate. I remember you mentioned that you really wanted to get into real estate, and this could be a good opportunity for it. You could turn After Hours channel into a vlog or real estate work. Market yourself as one of the few most transparent YouTube real estate investors. Could also compare performance to passive income. That'd be interesting. I think it's risky to change the content of a channel that dramatically. It's also kind of like, tucking in your tail and running. I don't like that look at all. I invested for 5 years and I didn't blow SPY away, so I'm just going to give up and turn around. I don't know if that's the best look. What I started this little competition with SPY was first of all, it's minority of my money in a more volatile portfolio where every single time I say, don't copy this portfolio. It's not suitable for 99% of people. It really is not. Part of the story fund was made for content. The passive income portfolio, the decisions are not made for content. The story fund was partly made for that purpose. So I've been very, very open about that. And I think it will be fun either way to see what happens with it. If it really gets destroyed, I want to do kind of a post-mortem, compare it to a bunch of benchmarks, see what went wrong with it. But hopefully we have a decent outcome. A lot of it just depends on how companies like Netflix are doing. I think Netflix is turning a corner. We seem to have a little optimism, but it could revert back and we could have another disaster. It's a very volatile stock. Again, I would not copy the story fund as a primary portfolio at all, but we'll see how it turns out. I do want to get into real estate investment anyway. My dad he's been very eager to get me into real estate. He goes, I know you have your YouTube channel and your stock thing and you're doing great on that, but real estate, that's how he made his fortunes, was real estate. My dad really loves real estate. He knows how to pick out a good property that will go up in value. He knows how to get renters in it. He knows how to manage it. He can fix everything with real estate himself. Whether you're laying concrete, changing paint, installing a new sink, anything, tile, he can do all of that stuff. So he's extremely handy. And then he knows the finances behind real estate. He knows that for me, or someone that is in a little bit higher income category, you can use real estate to depreciate against your taxes. So he keeps mentioning the huge tax benefits. He says, I'm paying way too much in taxes, which I am right now. So there'd be a lot of benefits to real estate. I should look at buying a property. I just get so wrapped up in doing YouTube and doing Qualtrim and this type of stuff, trying to grow this YouTube business, that it's hard to imagine taking on real estate at the same time. How's your brother doing? Is he still making a good living as a surgeon? Is everything going well in his life? Yeah, he is. He's partner at a surgery, eye surgeon business, vitreal retinal surgeon, and he does make a good living. It's interesting because he'll make really good money. Surgeon money is good money, but it's interesting because people always talk about how much surgeons make, and from his perspective, it's like if you want to make money, never go into surgery. By the time you get to that point, when you're at a level of surgeon that he is, you spent so much time in the schooling system and higher education, even outside of medical school. You have to do another 4 years of residency and fellowship and all this stuff before you can even get started. And then you have to find a practice and buy into the practice. And there's so much CapEx to even get all the machinery to do the surgeries, that you're basically a lot older by the time you make any money. So he's doing well. It's a stressful job. It's a very demanding, stressful job. Nothing like what I do. I tell him that I talk about stocks for a living, and he'll say I just did 4 surgeries on this one and this one, and this one was really difficult because of XYZ reasons and stuff. So we'll talk about that stuff. I think I could never do what he's doing. It's too stressful, too laborious. The hours are difficult. You're always called in for emergencies. Somebody will have something all of a sudden happen with their eye. They'll have to come in weekends, holidays, anything. Otherwise, people are really in trouble if you don't. It's a very difficult job. But outside of that, he's great. He enjoys life. He's good at his job. I think it's a cool thing to do. Where do you find your stocks other than super investors? I have a hard time finding compounders on my own. It's tough because I find them all in different places. Super investors are good, but they're kind of like cliquey a little bit, almost like they just invest in like the same type of group of companies. And I think people can become a little tunnel visioned. I think you got to be creative and look everywhere. I don't remember a single soul, not one person telling me that Texas Roadhouse is a quality long-term growth story, a compounder, a very good company. That I found on my own. And I found it by going to Texas Roadhouse. I should have invested in the company 10 years ago when they opened up a new location at my city, and there's there's a university next to it, big city. It was just packed all the time. I mean, a half hour it opened, it was just packed all the time. And I noticed that it just never was, it wasn't like it was just packed the first 6 months or the first year after year after year for the past 10 years. So I've been going there off and on a couple times a year at least. And I just noticed that it's always busy. And I thought, this is incredible that they're able to do this and pull this off. With so many other restaurants, I see restaurants go out of business so often. Ones come in and they leave and they just can't figure it out. So that was one that I found myself. Vici was another one that I found myself. Costco's another one that I found myself. Obviously, other people talked about it, but my conclusion was it was a compounder long before talking to anybody else about it. Apple was also one. I didn't find it myself, but Apple's one that it's just one of those companies that I've used their products for so long. I notice that they're always highly polished, incredibly good ecosystem, cohesive. Outside of what investors would call a moat and an ecosystem, from the customer perspective, you just call it devices working together well. Everything works in cohesion with each other. So that was another one that I feel like was mostly just using the company, learning about it. And that one's paid off big time. Apple is not a consensus of being this extremely high quality compounder. When I was investing it in 2019, it was talked about as being a good device maker at the time. Microsoft has been looked at as being a compounder for a long period of time. One of the ones that is similar to these others that I've used for so long, and I hope it turns out to be a good one. Right now, it's pretty neutral, is Netflix. I really think the company has momentum, and I think it has the potential to really be the consolidated winner in this category. But it's a little up in the air right now. So a lot of these companies that I find out are by my own use, finding different products that I really love, and then seeing if Not only do I love the product and the service, but I also like the financials when I plug them in the Qualtrim. You can't just have one or the other. You have to have both. You have to have a company that has amazing products and services and the financials are well ran. Because there's ones that have one or the other. There's a company, GoPro, for example. My brother had a GoPro. I had one. I thought they were like the coolest, funnest devices. You could attach them to your skateboard, or we went snowboarding with them. And they're just cool. But when I looked at it as an investment, I thought, I don't think there's any moat to this company. I don't know what the moat is. So it just didn't make a good investment. So not always, if you enjoy a product, is it a good investment. But when you find a company that is routinely over a long period of time, incredibly good at running their business, making customers love them, try to see if they're a good investment as well, because a lot of times they will be. Are you able to share your current holding with an average cost in the passive income portfolio, similar to how Datarama shows that for the current investors? Yeah, I'll send you a screenshot of all of them, depending on if you're looking at the story fund or the passive income. Just send me a DM. I'll send you a screenshot of it. It changes every day, so I'm always buying companies, and the gains and losses go up and down as well. Hi, Joseph. Can you touch on the trailing versus the forward PE and maybe the gap versus non-gap? Also, how will you use them analyzing a company? You know, a lot of investors, it's all a preference. Some investors only look at trailing PE. Some look at only forward. I look at forward PE when I'm doing simple analysis on the valuation of a company based on earnings. And the reason I do that is that's what most other investors use. And I like thinking, this is what the market's valuing this company at. They think the company is valued at a 22 forward PE. So that's the way that I look at it. You could use trailing PE. In terms of gap and non-gap, almost everyone, for every company they're looking at, in terms of forward PEs, they're using the non-gap, because there's some certain companies that will try to exclude things, amortize things. They'll in some cases, they do aggressive stock-based comp stuff, so you might have to factor that in. But most of the time, it's a way of expensing things to get to the actual earnings of the company. So most of them will use non-GAAP. I like using forward PE in combination with the cash flow yields. That's how I look at the overall valuation of a company. So I'm constantly referencing those two metrics. Do you think you could wrangle cattle, one of these questions, from horseback like cowboys at the rodeo? And if not, would you want to learn? I don't think I could. I haven't been horseback riding before. Horses are crazy, though. That when you get next to one, you realize how big they are. For some reason, they look almost smaller in movies. When you get up next to one, they're huge. So that'd be a different life if I was a horseback rider. That'd be a different life than what I'm living right now. The Yellowstone life is a bit different than what I'm doing now. Do you think NVIDIA's valuation is cheap if they keep their future AI growth in perspective? Their outlook estimates 50%. Yeah, if their estimates are crystal clear and they just keep meeting these estimates, then it is cheap. It'll go up to $2 trillion. I think it's risky. I think it's really risky. Companies change their growth trajectory and estimates all the time. Demand can shift on a dime. So with some companies, I feel very confident in their long-term future growth because I feel like I understand the consumer, I understand the industry they're in and the competitive dynamics. With NVIDIA, I have no ability to confidently forecast what their future is going to look like. I didn't think they're going to bump up estimates that much. I had no clue. And if I invested in them today, I have no clue if they're going to bump down estimates. Think about how wrong they were in the good way. They were underestimating things. But that's still an incorrect estimate. It shows that the company has the ability to make wrong estimates. In this case, it was good. They went, whoa, we have way more demand than we expected. But that should make you question if the company's able to have an incorrect estimate so much that NVIDIA did, that they're now saying it's going to be way above what their even wildest dreams were just 3 months ago. What does that tell you about the future? Maybe it goes the other direction. Again, predictability key. Predictability is one of the biggest things I'm looking for. If you want to go on a more wild ride, then you can look at NVIDIA. I just do not know enough about the industry to feel confident in investing in it. If you're investing at high expectations and high growth, I think you should have an extremely good understanding of what you're doing. I think when there's more neutral estimates, for example, if you're just buying Walmart and Walmart's forecasting an average year, I don't think you need to know anything about Walmart or the retail business. It's a company that's been around for a long period of time, forecasting an average year, unlikely to get in too much trouble doing that. If it's forecasting an insanely high growth rate, that's when you really have to do your homework because there's more variability in the outcome. Joseph, how do you view the recent Vici acquisitions of 4 Canadian casinos? How does it affect your investment thesis for the company? I think it's good and bad. I think it's good because they're getting good deals on them. They're expanding internationally, so it's signaling to it's a signal that they want to go international. They're going to be going in Europe and Canada and everywhere else they can. The bad is, I view Vegas as the premium assets, irreplaceable. And when you already own that and you're getting a good yield, it's almost like a little bit further dilution from those premium assets when they're going and buying different things. I do not think the 4 Canadian casinos, which are smaller regional casinos, are as good. They're more concentrated. They're more reliant on gambling. They're not as diversified as an entertainment utopia as Vegas. So you can look at this both ways. I have mixed feelings on it. I don't really think it hurts the company necessarily, but I like Vici right now. I'd be fine with them doing very modest acquisitions, just a couple here and there, and then having their rent raises bump up my dividend and the AFFO every year. So I don't expect them to do too much aggressive acquisitions from here. Would you please do a deep dive into Monday, considering doing a video? I've looked at Monday before, actually. When did I do that? I did a video on Monday. I know what it is. It's somewhat like an elaborate to-do list organization. We used it in development. When I looked at Monday, I think it's difficult to find a substantial moat with these companies. And a couple things, I'll point out a couple things here. Let's see if I can find it again. So let's bring up Monday here in Qualtrim. Now I want to just glance over some metrics. So Monday, to get the formal definition, together with its subsidiaries, develops software applications, a cloud-based visual work operating system that consists of modular building blocks used to assemble, create software applications and work management tool. This is the most flowery way of saying it's a very good, almost to-do list. Like if we go to, let me bring it up here. Let's go to Monday. They have all their different stuff they do, but their main product looks just like this right there. The roadmap. You have a list of stuff to do, and then you have the owners and the status. It's a to-do list. There's lots of to-do lists. Monday makes a really pretty one. I think it's a good product. When I was using it, I liked it. It has all the little features you'd want. Seems like a good product, but you got to get past the salesy, nonsense that these companies do. Don't get sold when you're reading the description. They write the descriptions of what their businesses are, and they give them the most flowery explanations. Monday is just SaaS software that companies license to have a nice user interface to organize workflows, to do to-do lists, and you can assign people stuff. So it's one of those companies, and they're expanding out from that. But what we look at here is a company that in 2022, okay, I haven't looked at this for a long time, but in 2022, it did $519 million, so roughly $500 million in revenue. And let's take a look at this here. Let's go to the expenses and just look at sales and marketing. They did $519 million in sales and marketing in 2022. In revenue. $519 million in revenue, $392 million in sales and marketing. So to summarize, they made $500 million and $400 million was spent on sales and marketing. So basically they're a company that pulls in all this revenue and gives it all to their salespeople. That's what's going on with it. And then the remainder of that goes into research and development, general administrative, and not much CapEx. They probably use AWS or something to host their joint. But what you're getting is a company reliant on a sales team to actually grow. And that's a difficult thing to actually churn out meaningful cash because the salespeople are expensive. It looks like they're going in the right direction. You look at the stock-based comp. Yeah, they could probably get to a point where they're profitable beyond stock-based comp. They're not there yet. But that's my problem with these companies. If the company is only business to business, the problem is that the company's reliant a lot of the times on aggressive corporate sales where they have to grow inorganically. They have to continually hire salespeople. And it's just tough. There's a couple companies that can pull it off. Salesforce, I think, one of them. When they do get clients, a lot of times they'll last for a long time, which is a good thing if they have a really sticky product. But I like companies a little bit better like Spotify, where they don't have to hire all the salespeople. Spotify had better economics. It'd be a great investment. Maybe they'll be able to change their economics. But that's my problem with Monday is primarily it's just a salesperson, growth-driven company. As soon as they let off the gas to try to make more profits, their sales slow down and another Monday competitor comes in with their sales, and it's just so much money trying to grow these companies. I like companies that just grow without so much money put into it. Netflix can grow subscribers with a small marketing budget because Netflix creates stuff that people talk about. There's buzz. It sells itself. If you get another viral Wednesday series or Jeffrey Dahmer or whatever they're making at the time. Suppose, for example, at some point down the road, you need to sell off a chunk of your portfolio to fund a large purchase or to pay for education. What strategy would you employ? Trim a bit of everything equally, or sell out of some position and completely minimize tax burden. If I'm way up in my portfolio, I might sell my weakest conviction position or one that's in a loss. So if I have a big loss position, I might sell that one to realize the loss and then hold it for tax withholding purposes. Otherwise, if all of them are just doing well, I just trim off all of them equally. Hi, Joe. All of your investments in M1, or do you have additional investment vehicles, a 401k, IRA, and HSA? They're all in M1 currently. I'm in the process of funding a Roth IRA in Schwab, and that's just going to be an SCHD or SCHG, 100% of it in that. But I haven't done that yet. It's still on my to-do list. Do you think it makes sense for me to consider buying companies like Ulta or Texas Roadhouse if I've never accessed them, store restaurant, because I live in a place where it doesn't operate? It's a tough call. I think it's difficult to do that because part of my research of Texas Roadhouse is going to the restaurants and seeing if it's busy. But I think you can get most data. You can't get customer service and certain aspects, but you can get most data. One thing that I recommend doing if you're interested in Texas Roadhouse is downloading the app. Even if you're outside of an area, you can use it and just pick random locations and look at the lines. It's incredible how the wait lines every single weekend are usually 50 minutes or longer. That's one gauge that I use to see how the company's doing. If I saw weekend after weekend of there being no waits across the US, I think that we'd be in trouble with the company. But I think it's fine to do this, but not generally my favorite thing to do. I have less luck when I can't see the product or actually operate with the company myself. You've made multiple videos talking about Buffett, but could you do a quick video analysis on Jim Simons? I actually have a video on Jim Simons. How can his performance be so high? That was one of the earlier ones I did, I think like 2 years ago. Yeah, so he did it based purely off of technical trading patterns. He pretty much did like what people envision ChatGPT doing with the stock market, but he did that like 20 years ago. He hired the best data analysts. They all got together. They built this firm. They built this computer that looked at they fed market data all the time of stocks trading everywhere. And it looked for patterns that humans couldn't recognize. And then it did like millions of trades a day to try to get ahead of these patterns. And it just printed cash. It wasn't based on the fundamentals. It wasn't based on any investment thesis. It was totally just looking at persistent things happening in the market, human behaviors of trading patterns and getting ahead of them. But Jim Simons has said, and the fund shows, that strategy is not working so much anymore because he has a bunch of copycats trying to do the same thing. When you get copycats doing the same thing, the margins get thinner and thinner. It's harder to make a gain, and all of a sudden those exploits are gone. So mathematically, it's like nearly impossible, I believe, to make a killing doing what he did so long ago. It makes sense to count on predictable growth with companies that have predictable business models like Costco, for example. How can you expect predictable growth in a particular product like Monster Drink? For example, another product like a beauty brand, what if the brand suddenly goes out of style? People switch to Red Bull going forward and start preferring a different brand or makeup. When I look at history, I don't see that happening too much, although it does happen a bit. There are a lot more drinks than Monster Energy. They used to be like the one and only energy drink, and now there's just a proliferation of brands saturating the market, and I do believe it will drop down the return on capital that Monster's enjoyed for the past 20 years. They're not going to grow as fast. I don't think they'll have quite as much pricing power because there's just so many other alternatives. Monster can't raise the price of their drink to $4 or $5 when there's Bang and Rockstar and Celsius and all these other companies making energy caffeine fueled drinks. What I would say though is when people, they tend to get into a habit with something, a routine, and they just stick to that routine. And in many cases, especially with something that's so routine driven as getting your caffeine drink, they'll just drink the same one month after month, day after day, year after year. With Monster Energy, I think there's people that literally drink it every single day, and they will for a long period of time, and they're probably not going to switch brands. So I think it's much more stable than a lot of other things. But yeah, it is true. There is a level of disruption. That's why a lot of times the better companies that are still high quality compounders have multiple brands. They have franchises. So if you think about this, Coca-Cola has done really well, not just because of their name brand drink, but also because they own a ton of brands underneath it. So if one of them is doing a little bit weaker, they can still push sales through the other brands. And then they can do acquisitions of even smaller brands and competitive threats and that type of thing. So a franchise of diversified products does help out a company like that. You can do that with software as well. Microsoft isn't just one product. It's a franchise of tons of different applications. So if one of them is doing a little bit weaker, Office, the Office suite or something like that, then Azure might be doing well. If Azure is doing, the gaming portion might be doing well. The same thing with Intuit. It's not just TurboTax, it's not just QuickBooks, it's MailChimp, it's Credit Karma. They have a franchise of products they can move from one to the other if one of them is doing poorly. So I do think it's less risky to have a company that has a franchise of good products that they can kind of use than just reliant on one product under one name. Monster's tried to do this. They have the same brand name, but they have a ton of different products under it. And they have huge distribution. So I think they've done a really good job, but they're battling a very competitive industry. Just a thought, and it's not fully developed, so it might not make sense. But when looking at a REIT, they issue shares and buy assets in a way they can't compare to the same with stock-based comp and cash. Like give out stock-based comp to employees which have limited use and then use the extra cash to generate more for shareholders. You can't turn a stock into a product, but you can turn cash into a product or something like that. Obviously, it can be abused, but doesn't that have some value that stock-based comp doesn't? I think what you're saying there, I agree with it. What I would say is with REITs, even the stock-based comp doesn't make too much of a difference because REITs, for the size of assets they own, for their market caps, they have very small amount of employees. It's nothing like these other companies. They have a tiny amount of employees, like a couple hundred that manage a huge REIT with $30 billion of assets. I'll do a couple more questions here before we close out. Take a look at HHC, Howard Hughes Corp. That, I think, is Bill Ackman's. Do you have any screens that you run periodically? No, I don't do that where I'm like constantly looking at specific screens. I look at the dip finder frequently, and I have different watch lists I look at. So I'm constantly looking at different watch lists with the dip finder and seeing where things are trading, because then I can go, wow, this, I'll even look at the one day and see how things are trading today. I'll bump it over to the past month, and that will draw my attention sometimes. Like, what's going on with this company? Why is it doing well this week? Or why is this one going down? And then I'll look at it and see if there's any news. So I'll do that, but I don't look at any screens per se. What are your thoughts on Target and their current downturn? It seems like a bit of the market overreaction and the stock would be at a discount. It could be. I think it's just having a reversion to the mean. So Reversion to the mean is a risk you take if a company has an unusual bout of growth. We can look at Target here, and this should show you, it should illustrate the usual bout of growth. I can just do a normal growth rate right here. It's about normal. Okay, so it's growing like what, 12% earnings per year. And then you notice right here, abnormal. Now what happened right here? I'll tell you what happened right here. 7T. $7 trillion through different subsidies, through the Federal Reserve, through pausing school loan payments, through direct stimulus, through every business owner receiving cash if they keep their employees. $7 trillion of stimulus given to the Americans in 2 years, like a year and a half. $7 trillion is a lot of money. Now that money needed to find a home. And as Americans, we have something in common. We love spending money. It's like a pastime. It's what we're really good at. So we spend all the money. And when we're thinking of places we want to go spend money, lots of people out there love Target. It's a nice, they got the plastic carts. They got a Starbucks in there. It's an enjoyable thing, right? You just go to Target. They have a fun place to shop. Now there's other places as well that they also acted like sponges soaking up this money. But this money had to find a home, and you can see some of it found its way to Target. Now, when I was looking at this, I thought, wow, that's really fast growth. To me, that seems a little bit unnatural, like scary, unnatural growth. And the risk of growth this unnatural, your earnings doubling essentially in 1 year, is that there's going to be a reversion where it goes back down to its normal trend. Okay, so we had a big bump up. Stock price goes up to follow the earnings, like it often does, and then it goes back down because the reversion in earnings happen. That's a risk we take. Now we look at this as well. We have like the normal stock price growth, and then we have the doubling that happened, and then we have the reversion going back down. If you were to overlay the earnings with the price, it would look pretty in line. The price is just following the earnings. So it's not a matter of the price just recovering. It's a matter of the earnings recovering. That's what we should be looking at with Target. Now, the interesting thing that happened is notice how this didn't happen with Costco. Costco's earnings went up a little bit less than Target's. They weren't so dramatic, but there's no reversion. And the reason why is because Costco makes money through memberships. So if they just gain more members, then they make more money. And they make very little money through the margin of their product. They make some of it that way, but most of it is through membership. If I could chart it out here, the majority would be through the membership because they have such low margins. Target makes a fortune through their products. So unlike Costco that makes their money through their membership, Target doesn't have memberships. They make all their money through product sales and charging a higher margin, about a 4% margin. So when Target sells a little bit less merchandise, their earnings get crushed. When Costco sells a little bit less merchandise, their earnings go down, but not nearly as much because they're still selling memberships. And another way of the business models show very different outcomes. So Costco hasn't had that reversion in earnings. Hence, when we look at Costco, it paints a different picture. There hasn't been such a huge earnings. It's gone down a tiny bit, but not much. And it doesn't look anything like Target's. So if you're a Target investor, what you're doing right now, what you should be doing is trying to determine how Target can get back on track with its normalized sales and earnings and grow, and when that happens. Does it happen right now? Is it going to start taking off with its earnings and get back to its normal trend? Because if that happens, the stock price will start to trend back up as well. That's all for now. I hope you enjoyed the AMA. I'm going to be doing another one relatively soon. We have a lot more content coming out next week. A lot of fun videos planned. I have some good content planned. I think it's going to be fun. That's all for now. I'll see you on the Discord.